Welcome to the Deep Dive, where we deliver the crucial insights from earnings season directly to you.
Hello, everyone.
Today, we are cracking open the vault on PAR Technologies' Q3 2025 conference call, which was held back on November 6th.
That's right. And for those of you following the restaurant tech sector, PAR is on a pretty crucial journey right now.
So our mission today is to cut through some of the headline confusion.
Exactly. We want to isolate the key operational and strategic takeaways from this quarter as PR really tries to solidify its position as a pure play, cloud-first platform.
Right, for things like POS, ordering, loyalty, and all the back office solutions.
Mm-hmm.
And if you were only looking at those immediate headline numbers, you might have been left scratching your head. They looked pretty mixed.
They did. You had a strong revenue beat, but the earnings per share, on the surface, it looked a little negative.
But the market, it delivered a very different verdict the very next day.
They absolutely did. I mean, the initial print was a bit messy, but once investors had time to really digest the underlying operational details and the forward guidance, they reacted with some serious conviction.
How much conviction are we talking?
The stock soared 16.6% the following day, and the volume was more than double the daily average. This wasn't just noise, this was institutional buying.
So they're buying into the efficiency and growth story management has been pitching.
That's the one.
Okay, before we dive into the proof points of that, let's establish the battlefield. What exactly were those mixed headline figures that caused the initial pause?
So revenue is fantastic. They delivered $119.2 million.
Which is a beat.
A material beat, yeah. It topped consensus expectations by between 5.8% and 8.3%, and that translated to a really robust 23.2% growth year over year. So, top line health.
But then we get to the earnings picture. GAAP EPS from continuing operations came in at negative $0.45.
Yeah, and that was a slight miss against the consensus estimate of negative $0.43.
So for our listeners who focus on those traditional metrics, that looks like a stumble.
It looks like a stumble if you don't know where to look. The number that truly drove that stock jump was the non-GAAP, or adjusted, EPS.
That was it.
It came in at a positive 0.06 cents.
Wow.
Yeah, a significant beat against the commonly tracked consensus of negative 0.002 cents.
Hold on. So why is GAAP consistently missing while the non-GAAP number is positive? I mean, if we're talking about operational leverage, what are they excluding to make that difference? Why are we calling the GAAP result noise?
That's a great question, and it's really common in these growing software companies. That gap is largely driven by non-cash charges.
Like stock-based compensation.
Exactly. Stock-based comp, which they use to pay talent, and also amortization from acquired assets.
Mm-hmm.
These are real accounting expenses for sure, but they don't reflect the day-to-day cash performance of the core software business.
So investors are looking past that.
They are. They prioritize that adjusted EPS figure to see if the engine is truly running cleaner. And in Q3, the engine was running clean enough to flip positive.
Okay, so if the operational engine is clean, we should see that reflected in the fuel gauge.
Mm-hmm.
Annual recurring revenue.
Mm-hmm.
This is where management really needed to prove they could accelerate after, frankly, a pretty soft Q2. Did they do it?
They absolutely delivered. And this was, I would argue, the most important metric of the entire quarter. ARR reached $298.4 million.
That's up 22% year over year.
Correct. But you have to look at the sequential growth. In Q2, incremental ARR, so the new business they added, was only $5 million. That spooked the market.
And this quarter?
This quarter, incremental ARR grew by $12 million.
Wow, so they more than doubled the sequential adds.
Exactly. That $12 million sequential growth, it translates to an annualized 17% rate. It's a sharp pivot, and it confirms that whole second half acceleration thesis.
It signals that those big enterprise deals in the multi-product bundles are starting to ramp up.
Right. It de-risks the worries that followed Q2.
Okay, let's break down the revenue components. Subscription revenue grew 25% year over year to nearly $75 million. That's the healthy SaaS score we want to see.
It is.
But hardware revenue was also surprisingly strong, up 32% to almost $30 million.
Yeah, and that hardware story comes with a necessary asterisk.
Okay.
Management admitted this growth was partly a pull-forward effect. Customers were rushing to place large orders ahead of anticipated tariff price increases.
Okay, so a bit of a one-time boost.
Precisely. While it's great for Q3 revenue, management expects hardware margins to normalize back into the mid-20s range in Q4. So we should view that hardware beat as a one-off, not a new trend.
Got it. Now let's move to the second major financial milestone. The profitability pivot, which you said directly relates to the stock jump.
It does. Adjusted EBITDA reached $5.8 million, which is up significantly from $2.4 million a year ago.
And there was a little nuance there too, wasn't there?
There was. Management noted that if you exclude about $800,000 in non-period accounting adjustments, the normalized adjusted EBITDA was actually $6.6 million.
So the takeaway is simple. Profitability is improving much faster than anyone anticipated.
Right. And here's the metric that changes the risk profile entirely. Operating cash flow.
Okay.
After years of major investment and, significant cash burn, the company hit a breakthrough.
They're cash flow positive.
Operating cash flow turned positive for the quarter, generating between $8 and $8.4 million in cash.
That is the clearest proof that the operating leverage is finally kicking in.
It is. For years, the bear case was, great idea, but they burn cash forever. This pivot fundamentally changes that risk equation, especially now that they're talking about M&A again.
And that cash flow wasn't just driven by revenue, it was from cost control. They kept talking about maintaining a flat cost base.
Oh yeah, and look at the numbers. Non-GAAP operating expense as a percentage of revenue dropped to 44%.
And that figure stood at what, 60% just 18 months ago?
Roughly, yeah.
Wait, a 1,600 basis point drop in OpEx as a percentage of revenue in 18 months? That's not marginal efficiency, that's a deep operational shift. Where did they find that kind of fat to trim?
It was a combination of things. SaaS rationalization, optimizing their tech stacks. And they specifically mentioned this, internal AI utilization is helping drive savings.
So they're using their own medicine.
Exactly. It validates the claim that the tech they're selling is also solving their own internal profitability issues.
Okay, and speaking of that, let's talk subscription service gross margin. Non-GAAP margin was 66.2%.
Solid, right. But management gave us a crucial nugget of information.
They did. They revealed that if you exclude the impact of a legacy, low-margin acquired contract that's dragging the average down, their core software margin was actually over 70%. Over 70%. And it's improving.
They drove a 150 basis point improvement in that core margin year over year.
So if we look at the PAR that management wants us to see, the pure cloud platform business, it's already a 70% plus margin business. Why is that 70% level such a critical signal for investors?
Because it tells you the long-term unit economics are sustainable and profitable. A 70% gross margin is the benchmark for high-quality enterprise SaaS.
It confirms that as they scale, most of every new dollar flows through to operating profit.
Right. It reinforces the whole argument that this is a highly valuable, scalable software asset, not just some low-margin hardware vendor.
All right, shifting gears from economics to the strategic roadmap. The whole call seemed to focus on one core concept, the pivot to becoming an AI-native platform.
Yeah, what's fascinating here is the launch of PAAI. Management stressed that this is an AI-native intelligence layer. They kept repeating the phrase, built in, not bolted on.
Built in, not bolted on. That sounds fantastic, but let's be realistic here. Isn't AI native just the new cloud native, a term everyone uses now?
It can be.
So what tangible evidence did they give that this Coach AI actually delivers value that a competitor couldn't just replicate with an off-the-shelf LLM?
The differentiation, according to them, is in the workflow integration. The prime example is that Coach AI assistant. The claim is an operator doesn't need to run complex reports. They can just ask questions like, which stores should I focus on today? And get an actionable answer instantly. If it really eliminates the need for external BI tools, that's real value.
And that better together thesis is being tested with these large deployments.
Absolutely. And they confirmed they're accelerating on those, specifically the crucial Burger King POS rollouts.
And they're on pace for their 2025 targets.
They are, and that's paramount because successful execution here de-risks the revenue visibility for 2026. This isn't just theory anymore, it's real-world installation.
And the future pipeline looks equally robust. Management said the late-stage weighted pipeline for POS more than doubles the existing $20 million contract backlog.
It does. A doubling of the pipeline provides incredible forward visibility. It validates the massive investment they've made in the platform over the past few years.
The Better Together strategy also showed up in their Engagement Cloud segment.
Yeah, this is where they showed real competitive strength. They noted over 70% of recent engagement deals were multi-product loyalty, ordering, and pay all bundled.
That high attach rate is a great sign.
It is, and they gave a powerful anecdote. a 400-plus location PAR ordering win that they took directly from a major market leader.
So that validates that their integrated approach is working against siloed competitors.
It seems to be.
Okay, what about the outlook?
They reiterated the full-year revenue target of nearly $450 million, and they maintained their organic ARR growth target at mid-teens as a baseline.
Now, that mid-teens baseline is moderated from a previous 20% target.
It is a necessary adjustment after that slow Q2. But the expectation, based on Q3's momentum, is that growth will accelerate into 2026 as these huge deals move from backlog to deployed revenue.
And finally, M&A. They have over $90 million in cash.
Right, and management noted they're opportunistic in what they called a buyer market, where sector multiples have compressed. They stressed any deal has to accelerate growth without compromising profitability.
So no more buying growth at any cost.
That's the message.
This brings us to the core puzzle for investors. Despite this phenomenal quarter-positive cash flow, accelerating ARR, 70% core margins, the stock is still deeply depressed.
Yeah, it's down over 50% year to date and trades roughly 60% below its 52-week high of $82.
Why is there such a massive disconnect?
Well, this frames PAR as a classic high beta fallen growth name. The market opportunity isn't the issue. Everyone agrees the restaurant tech sector is growing.
But the valuation is in the gutter.
Precisely. You have sell-side analysts with these incredibly high 12-month price targets, mid-50s to low 70s.
It's like 70 to 110% upside.
It is, but the market remains skeptical. It's because of past execution risks and concerns over how long it will take to achieve durable, stable free cash flow, not just positive operating cash flow for one quarter.
So management is pitching this multi-year AI platform thesis, but the market is heavily discounting the execution risk. It's a show-me stock.
It is. Investors are waiting for confirmation. They want to see sustained positive cash flow and continued acceleration in Q4. Success there will force the market to close that valuation gap.
And now it's time for our segment. This is not financial advice. This is where we model an outrageous but plausible trade idea pitched by, let's say, a hyper-bullish analyst who thinks the market just missed the memo on Q3.
Okay. Based on everything we've covered, the central thesis here is that the market is heavily discounting this operational pivot. The stock is near 52-week lows, while the company just hit positive operating cash flow.
And that de-risked backlog from Burger King provides a floor.
A visible floor under the recurring revenue base that the current valuation just ignores.
So if you're a believer in that floor, what's the aggressive trade to play the high volatility?
You implement a high-conviction long position in the equity. But here's the twist. Given the stock's high beta nature, you would partially finance this long position by selling long-dated, deep out-of-the-money call options.
So, for example, a $60 strike call expiring in late 2026.
Exactly. That strategy, like a covered call, monetizes the high volatility premium that exists in a stock like this.
And gives you an immediate boost to your capital.
Right. It exploits the high beta nature. If the AI story and the backlog conversion drive the stock toward those $50 to $70 analyst targets, the gain on your equity vastly outweighs any potential loss on that short call.
So it's a calculated bet on operational leverage, closing that valuation gap, while capping your absolute maximum upside to lock in a profit.
You got it.
A compelling pitch, betting on execution over skepticism. So to recap the key points from this Q3 call, the narrative is all about the pivot.
Absolutely. PAR successfully executed on cost control. They hit the milestone of positive operating cash flow.
And they confirmed that accelerating sequential ARR growth, driven by big multi-product deals.
The company has stabilized the cost structure. Now they're positioned to grow into their platform vision. The uncertainty is shifting from can they afford this to how fast can they execute.
Which leads us to our final thought. Given management's ambition to use M&A in this compressed valuation environment, the provocative question we leave you with is this. What kind of niche asset acquisition would instantly increase their organic ARR growth rate above that mid-teens baseline? Are they hunting for a new geography, a specific vertical, or maybe a loyalty AI niche?
The answer to that question will likely define their growth story for 2026.
Thank you for joining us for this deep dive. We'll see you on the next Talk Tickers.